here to make sense of all of the different crosscurrents in what I think is a very strange year. Please welcome to the stage Alexandra Semenova. She will be speaking, best reporter at Bloomberg. She'll be speaking about how to make sense of all of this with Jan van Eck. Jan is the CEO of Van Eck Funds. Stephanie Link. Stephanie is the chief investment strategist at Hightower. And last but not least, Lauren Goodwin. She is the chief strategist at New York Life Investments. Let's get loud. Welcome them to the show.
Good morning, everyone. Welcome to Future Proof. Thank you so much for joining us bright and early for what I know will be a fantastic conversation with this phenomenal group of experts. And later today, make sure if you see your friends who snoozed in today to rub it in their face that they missed it. The best panel here. There is so much to discuss at this very exciting time in markets. I think fair to say also in some ways unprecedented with so many cross currents with trade policy right now. And I want to start off with tariffs. I know that we're past some of President Donald Trump's self-imposed tariff deadlines, but there still isn't much clarity around trade policy. There are different levels on different countries, different sectors. Everyone's at different stages of the negotiation process. So how do you construct a portfolio when you don't know what the final trade framework will be and you don't know the impacts yet that tariff policies will have on the economy and companies? Let's start with Jan.
Okay, good morning. Thank you all for coming early this morning. So at Van Eck and sort of macro, we say, okay, what's the fiscal policy, what's monetary policy, and is there a major technology thing that we have to incorporate into our market outlook? I look at tariffs as just a subset of fiscal issues. We used to have a fiscal deficit last year of about 6.5% of GDP. I have counted that tariff revenue in, which is somewhere between $300 and $400 billion a year in additional revenue. And that's why I think there's a little fiscal constraint, and I think that's why the economy is slowing. So I kind of see the fiscal deficit going down to 5 to 5.5%. I don't think that's a crisis for markets, not a lot to do, but that's the trend I see.
Lauren, how are you thinking about tariff policy right now?
A couple of things we're taking into account. I think first that we should expect not to really have clarity on tariff policy. And one of the really interesting things that developed over the last few months is how little it's mattered for the rally as we see it today. What I mean by that is courts are challenging whether President Trump could have reciprocal tariffs via IEEPA. We don't know how things are going to be implemented, exactly what levels, but there's several things that we do know. We know that the average effective tariff rate will be higher today and in a few months than it was 6 months ago. We know that the implementation of those tariffs is likely to be more ad hoc, a little more chaotic. And we know now that that's likely to only really play out in the economic data starting about now over the next 6 to 9 months, if not more. And so there's a couple of ways we think about that in portfolios. The first is that we should expect that price pressures that are starting to reemerge that they'll be with us. It's not a double peak in inflation, but it is important for sort of market expectations around the Fed, et cetera. The second thing, though, that I think is really important is that this, let's say, non-traditional way that President Trump and the administration are implementing policy, it's become something that investors are willing to look through because of the uncertainty. So if we don't know the answers to things like trade policy, what do we know? And I think, Jan, you gave a great example of one of the ways that we can think about that. One of the ways that we're thinking about it is that if the equity market effects, for example, aren't as present as quickly until they hit the economic data, that untraditional policy is present in asset classes like the dollar. And so on a panel about sort of structural change, we try to really anchor in what are the 5 and 10-year changes that we're seeing as, frankly, not as a result of the policies like tariffs, but really just accelerated or continued by tariffs. And we do see tariffs as a piece in what has been a long-term trend and puzzle that's likely to continue.
Stephanie, do you think that investors can look past the uncertainty of tariffs?
I think they already are. I mean, we're up 30% since April, right? So, and everyone thought that it was the end of the world in April. And I think the reason we have rallied so much is because we are getting more clarity on what I call TGIF, tariffs, geopolitical issues, inflation, and the Fed.
That's great, TGIF, I love it.
Thank you.
That is a fantastic acronym.
So But we're slowly, so we don't have the answers on any of it, right? But we're slowly chipping away and getting more comfortable and figuring it out. And companies are figuring it out. So with tariffs in particular, as you asked, companies have actually been able to deal with it. And what I think is the most interesting is that business investment is up 10% on an annualized basis this year, first 6 months of the year. If companies had uncertainty, felt really uncertain about the environment, they were really all absorbed with all the things I just mentioned and all the things we're talking about, they wouldn't be putting money into investing. We wouldn't have a CapEx cycle. And it's beyond just AI, data center, power grid. We're seeing companies spend money because they are getting more and more clarity. And once we get through tariffs, which I think we're in the 7th inning, you're going to be able to now focus on the next game plan from the Trump administration and their growth initiatives, which is deregulation, and then also the lower taxes, not lower, but the continuation of low taxes. All of that, all of these things are reasons why companies are investing more and more, because now they've got clarity, and that's what I care about, that they put the money, the free cash flow that they have and that they're generating, and they're doing something with it. I love buybacks and increases of dividends and that sort of thing, but you got to grow your business. And I think that's what you're seeing.
Taking the F in TGIF, we have a pretty important Fed meeting next week where for the first time in a while, there is an expectation for rate cuts, but we actually don't know how much they'll go, especially after that jobs report we got on Friday. Do you think at this juncture it's the right move for the Fed to cut interest rates given we have a labor market that is decelerating but inflation that remains above their target? Lauren, let's maybe start with you.
I do think that they should be cutting interest rates, but I don't think that they should, and I don't think that they will cut 50 basis points. And here's sort of the calculus on it. The Fed cares about two things, inflation and employment. And the broad reach of policy changes that we've seen over the last 6 months are impacting both of those things in both directions. So this crowd will know all about the conversations with respect to inflation and how tariffs are working their way through the economy, et cetera. But in the labor market as well, we're at a really interesting point in time where demand for labor has stabilized, let's call it. The labor market has come into better balance. We have a bit of a no hire, no fire economy from a labor demand perspective, but labor supply is shifting as well as a result of, or at least in part as a result of immigration policy. And so that's creating a situation where we are likely to have very little jobs growth in the near term. But it's not just about labor demand. And so investors have gotten so used to thinking about the Fed's, the labor market side of the Fed's mandate as all about how much job creation there is, et cetera. But we might be in a situation, in fact, I believe we are in a situation where you could have very little jobs growth for quite a while and it not necessarily be a bad thing. So I think the Fed will take it slow here, starting with 25 basis points and give themselves a little more time to see what happens on the inflation side of their mandate. Now, I think that it's so interesting in all parts of the market, in private credit, in our public credit, in sort of the most risk-on equity investing. I hear investors kind of hoping for 100 basis points as quickly as possible, or 200 basis points as quickly as possible. But there's two reasons why I think actually a slow roll is the best thing possible for the market. One is that if you get a really quick decrease in interest rates, either something's gone really wrong or the market's going to sniff inflation from a mile away, and that's not what any of us want. Short rates go down really quickly, long rates are going to go up really quickly. Again, that's not going to help the housing market, that's not going to help the way that assets are priced. But the second reason I think it's really helpful if the Fed slow rolls from here is that we've seen in Europe over the last 18 months how, and when I was here last year, I got almost like booed off the stage for talking about how I thought the international environment was going to accelerate. It's a lot in part because there's been a more consistent interest rate cutting cycle without a recession. You see cyclical asset classes like financials, industrials, improving as a result of that, hey, things are pretty good, but we're seeing the cost of capital come down over a year type of environment. That is a really constructive environment for the, let's say, the 493. And it's also a good environment for encouraging M&A activity to pick back up. So I think the slow roll is not only the right call, but it's a bullish call.
You know, you mentioned M&A. Year to date, we have seen $2.7 trillion in M&A, 40% completion rate year to date, and 102% completion rate of M&A in the United States. So talk about a nice windfall, a nice tailwind. That's one of the reasons why, when you mention financials and other sectors, that's one of the reasons why financials have done so well, because the activity is starting to pick up in a very big way. And we haven't even begun to see deregulation on that particular segment. And then one other thing you mentioned in terms of the interest rate environment, it's not going to take much for the housing cycle to actually see a lift. In fact, many of the home builders are up 20 and 30% since they reported earnings, and they were crappy numbers, don't get me wrong. But if you get a real rate cut cycle and you can get housing to have a lift at all, it's 10% of the GDP in the country, but the multiplier effect is huge, right? You build a house or you buy a house, you have to furnish the house, inside, outside. You have to buy a car to get from the house to wherever you're going. So if you can actually get the housing cycle to recover, I think you're going to see upward pressure on GDP. And we're already above trend growth in GDP. So I think that's a big surprise to come.
So Stephanie, fair to say that you think that this pickup in M&A activity, deregulation, will be enough to offset some of the concern about the economy? Do you think that investors will be more focused on that part?
Yeah, I mean, if you look at the economy, and the economy is growing, you look at the Atlanta Fed tracker, I mean, and the numbers are all over the place, and we can't look at the exact number, but it's right now at 3% GDP growth. So it's taking all of the data that we have, and it's putting it into a system, into a computer, and it spits out a number, and you're at 3% growth. We might not be at 3% growth. Maybe we're like 2.5. That's still above trend. And it's driven by the consumer, which is 70% of the economy, the consumer, and we talked a little bit about the labor market. It's cooling. It's not collapsing. It's cooling. If you have a job and wages are running at about 5% annualized, you're going to spend. We are a nation of spenders, and retail sales will show you that month in and month out if you smooth it out. So the consumer is doing okay. And oh, by the way, inflation has come down from that 9% level. It's still elevated, yes, but gasoline prices are down double digits too. So there's a lot of moving parts, but the consumer's doing their thing. And then on the manufacturing side, we do have a renaissance going on in onshoring and reshoring, and it's all tied to, again, AI and data center build-outs and all that kind of thing. So I think that the economy has handled a lot of this stuff really, really well. And why do I care? I just care about earnings. And earnings just came in at 11%. Expectations were for 5%. And I think you're going to see double-digit earnings this year as well, because I think the momentum in the economy will continue.
Jan told us something interesting backstage. He said that he doesn't really care that much about the Fed.
I don't care about the Fed at all.
Why not?
I'll tell you why. Our perspective
Must be so
is
nice.
really don't look at next month's data, next quarter's data. We look at the world in 10-year trends. So taking a multi-year perspective, we had a lot of monetary stimulus after COVID, a lot of fiscal stimulus, like I said. The question is, can the U.S. have a responsible fiscal policy? And so that's the biggest risk. The risk of us overspending as a country is here. Whatever the Fed does is much less important. And when we ask about what do you do with your portfolios, we at VanEck say have some hedges. I don't know, this risk may never evolve. The Trump administration may be able to land the plane and get the fiscal deficit down to the 3% range. That would be wonderful. You don't know. But it really has paid off to have hedges over the last 2 years, right? Bitcoin has done really well, and gold has done extremely well. I don't even know if people realize that gold shares are up 90% this year. So it was a free hedge. It's really made you a lot of money in your portfolios. Even August, which is a slow month for gold, gold has continued to grind higher. We think it's part of a 10-year de-dollarization trend, so we would hold those hedges in our portfolio. So yeah, I don't really care what the Fed does.
Can I jump in with something about the debt sustainability question? So the U.S. is not ever going to do austerity. It's never going to happen, and it's never going to happen for most other developed markets either. And so fiscal deficits and just aggregate debt levels, it's a challenge. It's out there, but the way that it is going to get resolved is not going to be by cutting. Why can I say that with such conviction? The types of things that governments need to spend on have only gotten broader and more important. So, 5, 6, 7 years ago, I feel pretty confident that the folks in various government fancy houses all over the world were thinking about a digital revolution related to AI and the national security and sort of geopolitical consequences that had. But the COVID-19 pandemic made that sort of reality of supply chains obvious to everyone. We all understand the meaning of a supply chain and why it might be interesting to protect it. And so whether it's artificial intelligence and the digital supply chain, whether it's investments in the infrastructure to get us there, whether it's more traditional defense, whether it's climate or aging populations, you name it, the real needs for government spending have only gone up. And so I don't think that this is going to be resolved by governments cutting less. I don't necessarily think, though, that has to be a catastrophe. What we're likely to see is a reality for capital scarcity that means the private markets in the US, but also internationally, and by that I mean private capital, not government spending, are going to be more engaged. That's so exciting for our business, and as investors, there are going to be more ways for us to have a piece of that pie. I think we're also likely to see versions of financial engineering and other ways to sort of manage the government the debt carrying cost over time. But the idea that governments can just spend less without immediate consequences to these things that we're all saying are really important, I think is probably unlikely. And so I see that as really a vote in confidence and in favor of what you're describing, Jan, where the role that treasuries play in our portfolios and that the dollar plays in our portfolios is shifting. And so that broadening exposure, including some hedges like Jan outlined, I completely agree are so important.
You guys all spoke about taking a longer-term view. Valuations at current levels suggest historically that equities have weaker returns over the 5, 10-year time horizon. Do you see that happening again? And if so, what's the alternative to equities? Stephanie, let's start with you on that.
I mean, I think that the market is expensive at 22 times forward estimates, but there are pockets of the markets that are actually a lot cheaper than that. And I think that's one of the reasons why you are seeing a broadening out. And it's not just the Mag 7. They're expensive for a reason. They have a huge moats. They've got great free cash flow. They're in the best trends in terms of total addressable markets. So I'm not saying you go sell those. You hold them. But I think there's much more compelling areas in the market. And I touched on a couple of them. I mean, financials, I think those multiples are 14 times, and I know we look at price to book more importantly, but they're not really that expensive, and you have such tailwinds, things we haven't seen in years. We haven't had an big M&A cycle in years. We haven't had deregulation, so that capital levels and capital requirements are going to be reduced so that these banks can actually lend. We haven't seen that to this degree. Industrials, we talked about it a lot. AI, data center. You know how many data centers we have in the world? 11,000. We need 30,000 by 2030. We have 5,400 here in the States, so we're leading, but that is absolutely going to be a huge tailwind for the next decade. And so those earnings, those companies that are involved in, again, AI, you can own NVIDIA all you like, but I actually like the industrial companies that are building out this stuff. Quanta Services, Eaton Corp, Rockwell, Vertiv. I mean, I can name a dozen off the top of my hand, but I would just say that that's another sector that's attractive to me. Discretionary, as I mentioned, I think the consumer, if you have the right products, the consumer's buying it, especially in services, and those stocks are very cheap. Housing, they're trading at 10, 11, 12 times earnings, and we haven't even had a housing cycle, and earnings revisions are going higher. So I think there's so many places that are attractive. One area that I'm not attractive to, and I'd be interested in both of you guys, I'm not interested in energy. I'm interested in power. I'm not interested in crude and those companies.
Jan, how are you advising clients to play
I think we're on the same
AI?
page. We use different language, but what we've been saying is sort of the second wave of AI investment opportunities, right? And so I agree. I actually am provocative. I was like, how big can the Mag 7 be as a percent of the S&P? They're 35%. You know, the chart keeps going up. Why not 50%? I mean, they are fabulous, fabulous businesses, and I think AI is just another example where scale advantages will accrue to them. It's just crazy. They're such good businesses. We have a chart, or Co2 had a chart of Microsoft's headcount, which is flattened. They've actually laid people off this year, right? So their revenue's growing and employment is shrinking. It's just amazing. We've also been talking about nuclear. Our most popular ETF this year is nuclear energy ETF. That's the energy demand I think that you like, based on your comments. I also agree that large cap companies in industries, right, a big bank can get efficiencies from AI. So I don't know about small caps, but I do think the large companies in a lot of industries can really benefit.
Maybe just to take, to agree with both of you and just to take a step outside of equities, we've talked about a lot of really transformational trends related to AI and supply chains. I'd argue that some of those trends, you think about the global map being redrawn by competition over the AI supply chain. You think about capital scarcity that I mentioned. You think about some of the digitization trends and how stablecoin and tokenization developments are likely to really change the way we do investment products. You think about, I mentioned aging and what that will mean in terms of guarantees and the type of income that people want. And if you put all of those things together, the world's going to look a lot different in 5 years. And so one of the things that we've been thinking a lot about is what do you need to get there? And I think this is agreeing with both of you, some of the trends that you've outlined. You need the financing for the energy supply chain. Where does that take place? A lot of times it takes place in boring parts of the market, like in the municipal market. How do you think about global reality? Look, the S&P 500 has done fantastic since April, but as a dollar-based investor, you struggle, right? When you think about ex-US earnings and how any earnings are sort of translated back in US dollar terms. So maybe you want a little bit more of a different, a global geographic footprint. Do you manage that with a partial currency hedge so that you don't have to worry about those types of dynamics? These are the types of things I think that folks in our collective seat need to be thinking about, because not only the way that we move about the cabin and sort of the industries that are important is changing, but the way we access that opportunity is changing. And so sort of broadening our aperture on the investment question, I think, is increasingly crucial for success on behalf of our clients.
I mean, I think that while we are probably in agreement on early innings with AI, I think you're in really early innings in cybersecurity. And I think because of AI, cybersecurity is going to get bigger and bigger, and it's going to be even bigger than AI. AI is not safe. We all know that right now. There's a lot of questions out there. And if you talk to chief technology officers, which we all do, they'll tell you they're spending on two things. One is AI, because they don't know what it means for their business. And the second is cybersecurity, because they can't wake up one day and lose their business. They can't afford it. So I think those are the two really big themes. I know AI is taking all the glamour, if you will, but you think you're going to see massive consolidation. There are 4,000 cybersecurity companies, public and private, in the world, and that's got to shrink. And I think the big five players are going to get bigger and bigger and bigger. And to that point, Palo Alto just bought CyberArk just a couple weeks ago. I think you're going to see the big five get bigger, and if that's a theme, you could either own the hack, you can own any of the ETFs, but I would absolutely have in your portfolio exposure here, because it's really early on.
Speaking of portfolio exposures, with all the different market forces that investors are navigating right now, from this inflection point for the Fed to a president who has an unconventional way of doing things, do you think that the tried and true 60-40 portfolio is still the way to go when you have so many other options like alternatives and crypto assets? Lauren, maybe let's start with you on that.
Sure. Look, the 60-40 benchmark for a long time has been just that, like a way to start a conversation. If we agree on the concept that diversification is important, that just gives you a starting place for how to talk about it. But 60% equity and 40% bonds hasn't really been anybody's benchmark for a long time. So I think the answer to your question is yes, the traditional 60-40 portfolio needs to change. But the concept of diversifying a portfolio is perhaps not, right? And so when I think about, there are two types of conversations that we have when it comes to working with our clients and constructing the right portfolio for them or for their teams. It's, first and foremost, do you want to treat private markets as alternatives? Or do you want to treat private markets as a function of the sleeve where they belong, in my view? So just to give an example, private equity is equity. It's illiquid, it's risky, but it has the same sort of fundamental characteristics as equity. So one of the conversations that we might have within the context of a 60-40 portfolio is maybe your 60% equity sleeve stays just that, but you have a certain percentage in large cap tech in the US and a private equity sleeve where you access your small caps, right? A lower middle market private equity sleeve to sort of enhance that diversification and rinse repeat with respect to the credit backdrop. I think one area where we have seen a significant change over the past 12 months that I think is appropriate, well, actually two areas. One is the geographic mix, which we've discussed. And then another is much more conviction in the true alternative sleeve. So Jan raised this earlier, but precious and industrial metals, including gold, currency, just the visibility of global change and what that might mean for building a ballast around your more traditional asset classes like equity and fixed income has significantly increased in our conversations.
Jan, how about you? Stocks, bonds, private credit, crypto?
Yeah, crypto I could talk about for the next 20 minutes, but I would just say that, again, with this 10-year view, the market that we look at in our thematic portfolios is India. There's no doubt in my mind that with all the economic reforms that Modi did and really not needing to do any more, but actually enacting one right now, they've really got a runway supposedly in the next 10 years to reach the size of continental Europe. And I think what we see around the world is it's so important for companies to have large domestic markets. So you'll now have a fourth, in the next 5 or 10 years. It'll be obviously US, Europe, China, and now India. The other thing I would say is if you haven't looked at India, look at their returns relative to the S&P. You'd actually be shocked. Like over the last 5, 10, 20 years, they were both performing well. And I think part of the reason is that India has a very pro-equity culture. They have 200 to 400 IPOs a year. So structurally, it's really good. If you're looking at it at all, there's a little trade spat going on between the US and India now. The market always trades at high valuations, but you may want to take a look because it's been a little soggy over the last 6 to 9 months.
I mean, Modi is going to spend $1.7 trillion on infrastructure between now and 2030. So I'm a big bull on India as well, not just for the demographics. As there's a lot of right. Yeah, right. There's a lot of other things that are going on, but Modi is very pro-growth, less government, and the infrastructure is a big one for him. So we talk about U.S. infrastructure and manufacturing and industrials, but international as well is a very, very big, powerful theme, pun intended, of course. But I would say that it's going to be like the third largest country by 2030, or maybe even sooner. And you're right, it has lagged this year because of the trade tensions and everything else. But when you have Tim Cook, who's the CEO of Apple, say he wants to build out of every iPhone that they make, he wants to build 1 out of every 4 in India. He makes now 1 out of every 7. He said he would do it now if he could, but they don't have the infrastructure. The ports are not sophisticated enough. So just think about that. If this is just one company that wants to do more there, and they can't. So I 100% agree with you on India.
I mean, and if you look at the local market there, I don't know what people think about when they hear the words emerging markets. They are living AI today just like we are. The biggest country user of ChatGPT is India. And a lot of the products, AI products, are being developed through competence teams there. So, but the old line companies are being punished, and new tech companies are being rewarded. So it's like the markets are so forward-looking. That's what makes this industry fun.
You guys gave me the perfect segue to this. President Trump last week on Truth Social tweeted, "We lost India to deepest, darkest enemy, China." How are you thinking about geopolitical risk right now? Is it something that investors are underappreciating? And how are you preparing clients for any potential volatility associated with it?
I don't think that investors are underappreciating geopolitical risk because it's such a sort of undertone of conversations at the moment, but I do think it's incredibly important and it's just difficult to handicap in a portfolio. So the way that we think about it is that some of the changes that have gotten so much attention this year are important. They're accelerants of a geopolitical trend, but that trend is probably 10, if not more, years in the making. The increasing importance of China, the technological change we've seen with AI, it's redrawing the global map, and we believe that sort of regime change from a more US-led world order to something that's a little more bifurcated, it is important for investors because it broadens the opportunities that we have to access different ideas, growth, et cetera. It also increases risks. So some of the portfolio construction ideas that I was sharing earlier around, really trying to follow the money, right? Really trying to access the ways in which those tensions are manifesting in defense and infrastructure spending, thinking more globally. I do think that investors over the last 15 years have become incredibly US focused, and for a very good reason. I don't think that focus is necessarily misplaced, but I do think that opportunities that are coming from the global environment are going to be a little more challenging to operate with and to access moving forward. And so that just awareness of let's say the long-term, the 30-year trend zeitgeist is important when considering exactly how we put our portfolios together.
I've never really made a lot of money when I get emotional about geopolitics. It's scary. There's no question about it. But it's not what I do. I'm not an expert at it. So I watch it. I'm mindful of it. But believe it or not, when tensions actually escalate, companies actually tend to spend more money on defense. One of the reasons why Europe has actually done pretty well this year is because of their fiscal and monetary policies, but also because they're spending a lot more on defense, and they are spending a lot more on protecting themselves. So I try to ignore it. I don't want to totally discount it, but I just don't think it's an opportunity. I think actually you do get opportunities because the markets will sell off on these concerns, but it really doesn't impact companies per se, the fundamentals. And so I try to look for opportunities without sounding really callous about it because I'm very mindful about it, but I just tend to put my blinders on.
I think we'd all agree it's impossible to predict the unpredictable, surprise events from geopolitics. And you have to stay invested. You can't just go to cash and hide because you see those potential risks, very low probability, high impact risks. But there's one change I'd like to maybe talk about in the global that's sort of a follow-on to this India trend, but it's also happened after we did the sanctions against Russia, which is this global demand for gold as the second best currency in the world. And it's just that the U.S. share of global GDP is slowly shrinking. It's not a bad thing. The rest of the world's getting wealthier. But they look at us and they don't know about our fiscal policy and they don't know about our political policy. So they're actually de-risking and buying more gold. Gold is now a larger holding in foreign central banks than U.S. Treasuries, which you can, any stat you can overemphasize. But I think that's just a sign. And so that's why we see there's no second best currency. It's not the renminbi, it's not the euro, it's not the yen, and it's not, those countries don't want to be dollar centric, and so they're looking to gold. So that's one thing I would say that's sort of a subtle daily, monthly trend.
Maybe one more just tangible example with respect to geopolitics, a positive thing that we've seen over the last 10, 15 years is that geopolitics used to really manifest in the market via energy prices and currency. And that's still true, but the importance that the US has gained in energy production globally has made that so much less of a risk for especially US consumers. When there's a shock or Russia's invasion of Ukraine is a really good example, a major shock to the energy markets that wasn't particularly felt in the energy markets for any meaningful amount of time. In fact, the first couple of weeks after that conflict began, the most impacted asset classes were energy and the Russian ruble and Russian equities. And this is getting to the part that I think is really important. After 2 weeks, the most impacted asset class was the German Bund.
And so all the geopolitical tensions and realities that we're seeing are really starting to manifest in a different way, which is an expectation of not horrific hyperinflation, but just kind of stickier prices globally. These big spending and trends and defense, et cetera, are resulting in just sort of a floor likely on prices. And then on the currency side, with central banks in particular, it's not so much your average investor yet, though I think it's moving in that direction, but central banks are de-dollarizing and putting their money in gold to sort of stabilize against what the risks that Jan is describing. So it's not a shock, it's more of a slow burn, persistent change, and that's where I think we need to have our eyes 5-10 years down the road of what that looks like.
But it's just amazing how I do a lot of client events, no one ever brings gold up. Like we're conscious of it, but like most people don't, it's not maybe part of their portfolios, but to your point, I mean, that makes me bullish because I think there's a lot of potential demand out there from investors in the United States, but right now I would say it's a zero. In fact, we have the largest gold mining ETFs, and we had like $4 or $5 billion in redemptions in the first quarter. But I don't think that's long people pulling out. I think those were people that were short using the ETF covering their shorts. So we're just like, and we haven't seen a ton of inflows yet. So to me, I just think it's this lack of, they're not as bearish as they used to be, and they got out of the way of a big rally, which is smart for them, but a long ways to go, which again makes me excited.
Yeah, and I think that this is an important dynamic because the data don't suggest that actually there's any outflows from U.S. assets as a result of the political concerns, et cetera, that we've seen right now. I mean, equity and bond prices are through the roof, et cetera. The only place we're really seeing it is in the dollar. And when it comes to the dollar, that depreciation is in large part a result of hedging and central banks moving towards gold. And so what that tells me is that there probably is significant room for that trade to play out. It'll just take a couple of years. So as an investor, again, I'm thinking, yes, I probably want a little gold. And when I have more international exposure to access some of these trends, I probably want to think about a partial currency hedge where I don't have the sort of minute by minute currency guts to hedge on my own.
I don't know about you guys, but I've been feeling a little bit of deja vu thinking about this time last year where many of us were at Future Proof and we were all kind of waiting for a Fed meeting where the Fed was going to cut for the first time in a while. How are you thinking about this time differently from last year? And how are you positioning for the possibility that we might see the same scenario play out where the Fed starts to cut and then has to pause? Is this time different? Jan, maybe let's start with you.
Jan doesn't care.
Yeah, I already said I don't care. Well, I'm looking back at last year. It was we didn't know who the president was going to be, right? So we have such a different mix of fiscal policies. I wonder on the monetary policy side, I don't love talking about the Fed independence issue, but I have been thinking, if Trump does sort of get all his appointees through next spring, will that be a source of destabilization? I just don't really know. It's very hard to have an investable thesis about it, but I'd be interested in what you all think. Not now, right? But in 6 months, when he's,
Well, in 6 months, Powell's going to be out.
Right.
And he'll get
And it'll
somebody
be
in
Trump's guy.
who's a dove. I mean, we already know, right? I mean, we already know all this. But look, I think there's this old adage: you don't fight the Fed, you don't fight the global central bankers either. So when they're lowering rates, that is very stimulative to the economy. And this time last year, we weren't growing like we are right now. We have an absolute manufacturing boom happening here, and that is underappreciated, and a consumer that just will not quit. So I don't know. I almost don't care, too, about like who's going to be in there and what's going to happen. But if they're cutting, I'm just going to take that as that is stimulative. That is a good thing. And I am of the mindset they're not going to be cutting because we're in dire straits in the economy. That's
just to emphasize the point you're making is that it is a global rate-cutting cycle. We're kind of the outlier.
Yes.
So it would be natural for us to kind of join the developed market crowd.
Lauren, what key differences are you thinking about this time around in the setup from last year?
I agree with the perspective. I would say if we were to talk about the risk, it's from my perspective, it's not necessarily this personnel or that personnel, but more the market's read on that, because the Fed's inflation fighting credibility is it's probably its most important policy tool. And if you're a big nerd and read all the academic papers that come out of Jackson Hole, there was some really amazing research talking about how when a central bank has proven that it can fight inflation over a medium-term time horizon, they actually have to do a lot less of, for example, hiking rates when there's an inflation problem. And I think that's exactly where the Fed is. We as an investment public should want that to stay that way. And so as long as the market reads what's happening as bullish, don't get in front of that train. It is a very bullish development. If the market changed its mind and started to sniff out, we feel that rates are moving lower for reasons that don't have to do with the dynamics we're used to, then again, even as the policy rate is moving lower, long rates are going to move up. That's how that will work. And so it's something I think we should all hope for. And in the moments where we've seen policy suggestions to the alternative of Fed independence, we've seen the markets or market-aware officials work on pumping the brakes. And so I think it's still, thankfully, an outside risk.
I see one question from an audience member, but before we get to that, I'm just going to do a little rapid fire with you guys, if you don't mind. Do you like Mag 7 or S&P 493, Stephanie?
493.
Mag 7.
Mag 7.
Stocks by the end of this year, higher or lower?
Higher.
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 How about by the
Great
end?
fourth quarter. I expect a great fourth quarter.
By the end of next year?
Higher.
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 The Fed next week is going to cut by how many basis points?
25.
25.
I don't care.
Thank you, guys.
I think his commentary is going to be much more important, right? Like the commentary of what they see. Are they more dovish or not? I mean, like Powell about a month ago or 2 months ago, maybe it was 2 meetings ago, when he came out and said they would have already been cutting if it wasn't for the tariffs. Then all of a sudden he wakes up one day and he's like, the tariffs are only going to be a one-time hit. Now we can focus on the labor market because that's their dual mandate. Like it's a lot of noise.
And if you're a nerd, we get their economic projections next.
Right.
Is that next week already? Yeah, it is. We get their economic projections next week, which give a good, concrete sense of what that looks like.
I care most about the Supreme Court decision on tariffs. That's like $400 billion of revenue that might have to be paid back. I mean, they're not going to do something that extreme, but that's a big, unknowable dynamic.
And now the question that I'm seeing is, with China's national focus on AI, how do you expect China and India to perform in relation to the other, and where does the U.S. stand in that mix? Jan, maybe let's start.
Well, I like India and the U.S. as good equity markets, but I just make this point that it's a global world. So I live in the New York City suburbs, and you know who also lives in New York? The second largest shareholder of Alibaba, Joe Tsai, who also owns the Brooklyn Nets. So to think that he is not in touch with all the leading technologies in the world and trying to implement it at Alibaba is insane. So he is. It's just you have more political risk by investing in Chinese companies because it depends on what Beijing thinks and what he allows. So I prefer India and the U.S. to China.
Or you can own U.S. multinational companies that have exposure to China. So because you'll get more transparency if you want to play that theme.
Lauren?
I wish he would also invest in Brooklyn's other basketball team, the New York Liberty. But no, I agree with what's been said so far.
I think he owns them. I think he does own them too, yes.
Spend more.
Or his wife, yeah. Yeah, they combined it. And a lot of Burgundy vineyards, but that's another story.
We very unfortunately have to wrap it up. We can keep going with this. Thank you guys so much. Thank you for
Thanks for
amazing
coming.
group of panelists here.